Swing points. Swing points are key reference levels where price momentum temporarily shifts. A swing high forms when a candle has lower highs on both sides, suggesting temporary resistance. A swing low is the opposite, when a candle has higher lows on both sides, indicating support. These points attract liquidity because retail traders often place stop losses just beyond them. Market makers are aware of this and will frequently drive price past swing points to trigger those stops and collect liquidity. What it means, swing points are targets for institutional moves. How to use it. Mark recent swing highs and lows on your chart to anticipate stop hunts or reversals, especially when price aggressively approaches them. Buy-side and sell-side liquidity. Buy-side liquidity exists above swing highs where breakout buy orders and short stop losses pile up. Sell-side liquidity exists below swing lows where breakout sell orders and long stop losses accumulate. These areas become magnets for price because that's where most retail orders sit. Smart money pushes price into these zones to collect liquidity, not because of market sentiment, but because that's where the money is. What it means, liquidity pools are engineered targets. How to use it. Identify these zones and expect price to raid them before reversing. Don't chase breakouts. Fade them after the liquidity grab confirms. Equal highs and equal lows. Equal highs and equal lows form when multiple swing points align at nearly the same price level. Equal highs look like strong resistance and equal lows like strong support. But in reality, they're zones filled with stop orders waiting to be swept. Retail traders see them as safe entry or exit points. Smart money sees them as liquidity magnets. What it means, these levels won't hold forever. They attract stop hunts. How to use it. Expect price to break above equal highs or below equal lows. Sweep the stops, then reverse. Use this to frame entries in the opposite direction. Old highs and old lows. Old highs and old lows are isolated swing points that haven't been revisited by price in a while. Unlike equal highs or lows, which are clustered, old highs and lows stand out clearly and often act as key liquidity targets. They represent unmitigated zones where many stop orders are waiting. What it means, price is likely to return to these levels, not randomly, but to collect liquidity. How to use it. Mark these levels and watch how price behaves when approaching them. A sweep followed by rejection signals. Potential reversal. These are often used in combination with fair value gaps or order blocks for high probability trade setups. Previous highs and lows. Previous session, day, or week highs and lows are important ICT reference points. These levels often contain resting liquidity from traders who place stops or breakout orders near session extremes. Price tends to be drawn to them, especially during key times of day. What it means, the market uses these levels to engineer moves and fake-outs. How to use it. Mark the previous day's high and low before the session opens. If price breaks one side and fails to continue, that failed auction can be your cue to trade in the opposite direction. Combine with daily bias or optimal trade entry for confluence. Premium and discount. The market is always moving within a range, from a swing high to a swing low, or vice versa. Dividing that range in half gives you two zones: premium, above 50%, and discount, below 50%. Smart money sells in premium and buys in discount. Retail often does the opposite. What it means, high and low prices aren't random. They're zones where institutions look for entries. How to use it. If you're looking to go long, wait for price to reach the discount zone. If shorting, wait for price to enter premium. This gives you better entries and improves your risk to reward ratio. Optimal trade entry, OTE. The optimal trade entry, or OTE, is a specific retracement zone used to enter high probability trades. It's based on a Fibonacci pullback between the 0.62 and 0.79 levels, with the midpoint at 0.705 or 0.75, depending on your source. For longs, the OTE zone sits within the discount area. For shorts, it sits in premium. What it means, price often retraces into this zone before continuing the main trend. How to use it. Once a swing high and swing low are identified, draw your Fibonacci retracement. Wait for price to enter the OTE zone and look for confirmation like a liquidity sweep, order block, or fair value gap before entering the trade. Fair value gap, FVG. A fair value gap is a 3-candle pattern that reveals an imbalance. If the first candle's wick doesn't overlap with the third candle's wick, the gap between them is the FVG. A bullish FVG forms when price rapidly moves up, creating a gap between candles. Bearish is the opposite. What it means, it's a sign that price moved too fast and may return to rebalance. How to use it? Mark the gap zone. If price returns and respects it, especially holding the 50% midpoint, it can act as support or resistance. Combine with structure or liquidity for higher probability trades. Fair value gap inversion. Sometimes price doesn't respect a fair value gap. It breaks right through it. In ICT terms, this is called an FVG inversion. After breaking, the gap flips from support to resistance or vice versa, just like a trend line or previous high-low. What it means, price is using the old imbalance as a base for the opposite move. How to use it? When a fair value gap fails to hold, wait for price to return and test it from the other side. If it rejects that zone, it's a good signal to enter in the direction of the new trend, using the flipped FVG as structure. Volume imbalance. A volume imbalance occurs when there's a gap between the open and close of 2 adjacent candles, even though their wicks may overlap. It's different from a fair value gap, which requires non-overlapping wicks. Volume imbalances signal an aggressive shift in momentum and often act as magnets for price to rebalance. What it means, price moved too quickly, leaving inefficient execution behind. How to use it? Mark the imbalance zone between the open and close. Price often returns to these levels to fill the inefficiency before continuing in the original direction. Use this in confluence with swing points, liquidity, or order blocks for better entries. Gap. A gap is a complete absence of trading activity between 2 candles. Neither bodies nor wicks overlap. This creates a true price void. Bullish gaps happen when the low of a candle is above the previous candle's high. Bearish gaps are the opposite. What it means, these areas often act as magnets for price, especially in indices and forex. They're filled more often than not. How to use it? Mark the gap as a zone of interest. If price approaches it, expect a potential reversal or consolidation. Watch for confirmation, like a liquidity sweep or reaction at the midpoint, before taking action. Consequent encroachment. Consequent encroachment is ICT's term for the midpoint of a fair value gap, exactly 50% between the top and bottom of the imbalance. While the whole FVG can be used as a zone, this midpoint is often where price decisively reacts. What it means, the market respects the midpoint more than the full gap in many cases. How to use it? When price returns to a fair value gap, observe how it behaves around the midpoint. A rejection here often signals continuation of the prior move. If price closes above or below it, the move may be weakening or reversing. Order blocks. An order block is the last opposing candle before a significant market move, typically a bearish candle before a bullish rally or a bullish candle before a bearish drop. These candles represent institutional accumulation or distribution. High probability order blocks have large bodies and lead to breaks of structure after sweeping liquidity. What it means, these zones are where smart money placed orders before a major shift. How to use it? Mark the open of the last down candle before an up move, or vice versa. Wait for price to retrace into it, and look for confirmation like a rejection wick or FVG alignment before entering a trade. High probability order block. This version of the order block features a large-bodied candle that sweeps liquidity and is followed by a break of structure. It signals strong institutional involvement. The ideal entry is at the candle open or at its midpoint if using a mean threshold. What it means, this block is more likely to generate a valid reversal or continuation. How to use it? Once liquidity is swept and structure is broken, mark the order blocks open. If price retraces to it and holds, it's a strong entry signal. Combine with premium/discount zones, or FVGS, for higher accuracy. Low probability order block. A low probability order block is usually a small-bodied candle, with large wicks sitting in the middle of a trend. It lacks a liquidity sweep or break of structure, making it less reliable. But it can still work when used with other confluences. What it means: weaker institutional interest. Riskier, but usable with context. How to use it: find small opposing candles within a trend, then mark the area between the candles open and high for shorts or open and low for longs. If price pulls back into it and shows rejection, it might resume the trend. Only act if you have confirmation. Mean threshold. The mean threshold is the 50% level of a high probability order block. Instead of entering at the open of the order block candle, ICT traders often wait for price to retrace to this midpoint. It gives a deeper entry with better risk to reward, and it's commonly respected by algorithms. What it means: institutions often defend the midpoint of their accumulation or distribution candle. How to use it: after identifying an order block, calculate the midpoint from the candles open to its close. If price retraces and holds above for longs or below for shorts this level, it's a strong sign of continuation. Combine with daily bias or liquidity sweep. Liquidity sweep. A liquidity sweep occurs when price spikes above a known high or below a known low to trigger stop-loss orders. Retail traders think a breakout is happening, but institutions are simply collecting orders before reversing the move. This is part of engineered market manipulation. What it means: price often moves to collect liquidity, not because of trend continuation. How to use it: identify swing highs, lows, equal highs, lows, or other retail targets. When price wicks above or below them and immediately rejects, that's your liquidity sweep. Enter in the opposite direction with confluence like order blocks or FVGs for a high probability reversal. Break of structure. BOS. A break of structure happens when price moves past a previous swing, high or low, confirming a new trend direction. It's not just a wick, it must close beyond the level. BOS validates that the market is shifting away from the old trend. What it means: the previous trend is likely over, and a new one is forming. How to use it: wait for a BOS after a liquidity sweep or order block to confirm that smart money has stepped in. This adds confidence to any entry. You can also wait for a retest of the broken level for a safer entry. Market structure. Market structure refers to the sequence of swing highs and swing lows on a price chart. An uptrend forms when price creates higher highs and higher lows. A downtrend forms from lower highs and lower lows. Consolidation is when price stays within a tight range, failing to break either direction. What it means: structure reveals the current direction and phase of the market. How to use it: identify whether price is trending or ranging. In a trend, trade in the direction of the structure. During consolidation, look for liquidity sweeps at the range boundaries. Combine with order blocks, BOS or FVGS, for precise entries. Premium and discount. Premium and discount refer to the relative positioning of price within a range. The range is defined from a swing high to swing low or vice versa. The top half is premium, expensive, and the bottom half is discount, cheap. What it means: smart money sells in premium and buys in discount. Retail usually does the opposite. How to use it: divide the range in half and only consider shorts in premium or longs in discount. For better precision, look for entries around the 0.62 to 0.79 retracement zone or the OTE. Always pair it with structure and liquidity. Daily bias. Daily bias helps determine whether the next trading day will likely be bullish or bearish. It's based on how price interacts with the previous day's high and low. If price breaks and closes above the previous high, expect a bullish day. If it breaks and closes below the previous low, expect a bearish one. What it means: price action around the prior day's extremes hints at where liquidity is being targeted next. How to use it: mark the previous day's high and low. If price sweeps one side and fails to close beyond it, it might reverse. Use daily bias to frame intraday setups. Old highs and lows. Old highs and lows are isolated swing points that stand out on the chart. They often represent uncollected liquidity because they haven't been revisited by price institutions. Target these levels to trigger stop losses and fill large orders. What it means: old highs, lows act like magnets for price. They're commonly swept before a reversal. How to use it: identify old swing highs and lows that haven't been retested. Expect price to run these levels aggressively, then look for confirmation like a rejection wick, order block, or fair value gap for a reversal setup. They're key zones for engineered liquidity grabs, previous day's high and low. The prior day's high and low are important reference points in ICT trading. These levels are often targeted during the current day as liquidity pools. If price runs either and fails to close beyond it, it often reverses. If it closes beyond, the bias for continuation strengthens. What it means, smart money uses previous day levels to manipulate retail sentiment. How to use it? Mark the prior day's high and low before trading. If price takes one and rejects, expect reversal. If it breaks and closes beyond, look for continuation setups in that direction, especially during New York session highs and lows. Each trading session, Asia, London and New York, forms its own high and low. These intraday extremes often serve as key liquidity zones. Price will frequently sweep session highs or lows during overlapping hours, particularly when large institutions are most active. What it means, session highs and lows are short-term targets for stop hunts and setups. How to use it? Mark session highs and lows. Look for setups where price sweeps one side, then watch for fair value gaps or order blocks on the reversal. This is especially effective during the London-New York overlap when volatility is highest. Fair value gap, FVG. A fair value gap is a three-candle formation where the first and third candles don't overlap with each other's wicks, creating an imbalance. It signals inefficient price movement caused by aggressive buying or selling. FVGS often act as magnets for price to return and rebalance. What it means, price is likely to revisit these gaps before continuing the trend. How to use it? Identify gaps between the wicks of candles 1 and 3. In a bullish FVG, look for price to dip into the gap and reject. In a bearish FVG, wait for price to retrace into the gap and reverse down. Use them with structure and liquidity for precision. FVG inversion. Sometimes price disrespects a fair value gap and trades completely through it. When this happens, the FVG can reverse its role. Support becomes resistance or vice versa. This is called an FVG inversion. What it means, a failed FVG often becomes a strong reversal zone in the opposite direction. How to use it? If price pierces through a bullish FVG and closes below, mark the zone as resistance. If it runs through a bearish FVG and closes above, treat it as support. Look for retests of the inverted FVG for high probability entries in the new direction. Consequent encroachment. Consequent encroachment is the midpoint of a fair value gap, typically the 50% retracement between candle 1 and 3. This level is frequently respected by smart money as a precise reaction point. It often acts as support or resistance even when the full FVG isn't filled. What it means, the midpoint of imbalance zones is highly algorithmic and predictive. How to use it? Once you mark an FVG, calculate its midpoint and watch how price reacts to it. If price respects the midpoint and rejects it, the gap is still valid. If it closes through it, the FVG may be invalidated or inverted. Volume imbalance. A volume imbalance occurs when there's a gap between the open and close of two adjacent candles, but their wicks still overlap. It represents a subtle inefficiency in price delivery, less aggressive than a fair value gap, but still significant. Smart money sometimes uses these zones as support or resistance. What it means, volume imbalances can indicate areas where institutions moved price quickly and may want to revisit. How to use it? Spot candles with a visible body gap, but overlapping shadows mark the zone between the open and close of the imbalance. Watch for price to retrace into this zone and react. Combine with FVGS, order blocks, or liquidity for higher confidence. Subscribe to Trading Strategist, the new best trading channel on YouTube, and like this video. I'll see you in the next one. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.